Thank you, Mark. Thanks, Mark. Thank you. Well, I'll start with our disclaimer, which basically says nothing I say can and will be used against me in a court of law, of course. I like to frame our conversations about our fund with a quote. So I'm going to start with Warren Buffett, who better than him. Basically, the quote here is, many would have seen this before, is predicting rain doesn't count, but building arcs does. And I kind of want to talk about how we invest in small caps globally with biblical floods in mind. So we don't start with risk at the end, we start with risk at the beginning of our process, and we think about how we can survive that volatility and create good opportunities for clients despite whatever may happen. Unlike these two dinosaurs here that obviously missed the boat. So what happened in 2022? Well, balance sheets, remember those? They became back in vogue again. When debt was really cheap, it was very fashionable to have as much debt as you could on the balance sheet to buy EPS accretion. You saw many companies in the small cap space do M&A just to buy earnings effectively, but when they became very swollen with gearing, it became a major problem. And so balance sheets became a thing again, and people started looking at balance sheets and caring about net cash, gearing levels, and obviously the big problem we're facing now in Australia is a mortgage cliff, and companies face the same thing. Worldwide, there's many companies that got fixed debt on their balance sheets, and as they roll off, interest costs will become a major issue and earnings will be crunched. So we're looking at balance sheets in the way we think about investing. Cash flow, again, became king. Actually, I want to say it became king, queen, knight, rook, bishop, and pawn. It became the thing. It's something that's absolutely central to how we think about investing in companies, and we'll show later on in the presentation why that's the case and why it does lead to structural outperformance over time. And then lastly, the last thing that came to mind again was valuation. During the heydays of the growth, it was kind of ironic, but I was up here 2 years ago talking about when rates got so low that actually cash flow burning companies outperformed cash flow companies. So people were paying more for cash tomorrow than they were today, but obviously with discount rates rising, valuation matters again, and we think that that's actually, again, very central to how we invest. The other thing that happened over the last couple of years is that growth and value changed their relative importance. So if you looked at this chart going back 10 years, you would have had that growth chart outperforming, and value managers got completely smashed up, and most around business now, you can't find value managers for love nor money. But over the last 2 or 3 years, this is the Russell Growth Index in the orange and the Russell Value Index in dark blue. Value actually outperformed again, so valuation again came to the fore. People cared about intrinsic value and underlying value as opposed to how fast you could grow a business. So why would you want to consider small companies, especially in a global context, when you can buy these great big businesses out there that are obviously very popular? What's interesting about small caps is that not only are they incredibly diverse, there's a ton of opportunities in that space, and we'll talk about that in a second, but they tend to get smashed up more in a sell-off and also recover a lot more when the market turns. Why do they get smashed up more? I guess they're smaller, so they're less liquid than large companies. They're more geographically focused than large companies, so they're less diverse. I think that's one of the reasons they tend to get sold off harder. And liquidity is another factor as well. So that's one of the reasons that you see these companies get sold off more aggressively, which creates bigger opportunities clearly when there's a leveling out and a recovery in the marketplace. And you can see that over 3 of the last sort of major corrections in markets, you've seen the dot-com sell-off. Obviously, the NASDAQ was the most affected because it was the most overvalued going into that period. And then small caps, which is the dark line, actually outperformed, obviously at a lower base, but then they had a really sharp recovery, as you can see, in March 2002, 2003, when that market recovered. Same thing in the GFC, sold off very heavily. And then obviously with the COVID sell-off, a very quick correction. And smalls and micros got really badly sold off in that period, and then they recovered a lot quicker and a lot further. And a bit like last year as well, we see the small cap markets get sold off a lot more, both domestically in Australia and internationally compared to the large caps. But that creates a really good opportunity. And this is a chart put together by our friends at Bank of America, Merrill Lynch, looking at the PE relatives of large and small caps over time. And it looks like we're at a period where that sell-off in small caps, that dislocation, if you like, has created a really good opportunity to revisit small caps as an investment class and maybe pick up some exposure to it. Having said that, how do we deal with small caps? And why is it exciting? Yes, it's exciting markets because it's been sold off and maybe it recovers more. But what else is unique about small caps? Firstly, it is an incredibly broad universe, and I'll show you in a second how many stocks we can look at globally. But that breadth of universe creates enormous opportunity. There's a huge disparity, but not just between well-known brands and lesser-known companies, between countries even. I mean, I remember living in the UK years ago, and there was a change in regulations in Germany, for example, where insurance companies had to sell out of equities and buy bonds, and they just dumped every equity they could find. So you had consumer stocks trading in France on 15 times earnings, the same consumer stock trading on 10 times in Germany because the Germans had to sell to put money into bonds, for example. So you get these weird dislocations in the world because of strange regulation changes that create opportunities for investors who can look around that universe and look at comparability. The lack of sell-side coverage is a big issue, and we'll talk about that. That's great for us because we love doing the work. And then obviously growth from a low base. If you're a small company, you can grow 10% a year for 10 years. It's not impossible, and it's not impossible for large companies to do it. You get Apple, Google, Facebook until recently were growing well beyond that for a period of time, but it's not common to see large companies being able to maintain that pace of growth for a period of time. So when I say unparalleled, if I can speak, investment opportunity, this is to give you some idea of just how large that index and that universe really is for us. Obviously the mega caps, there's only a handful of those over $1 trillion. But if you look at our universe, we define small caps as between 250 million roughly, this is all US dollars, and say 25 billion, which is the upper end of the small cap index. And we only look at the global developed markets. We're not going off piste into emerging markets. We're keeping it all very basic. Everyone speaks English to us, pretty much except for the Japanese. Everyone reports in the same accounting standards. So it becomes very simple for us to go through and do our research. But in our universe alone, there's 13,000 companies that fit that space. 13,000 companies. And to give you some idea of how that compares to Australia, there's only 550 or 526 to be exact companies, if I can stand aside here, that are over 250 million market cap in Australia. So we've got 26 times the opportunity set globally. It's enormous. What's interesting about that also is that the coverage is infinitesimally smaller. The large caps covered in the NASDAQ, we've got 28 analysts crawling all over the balance sheets. Sorry, 28.2. We don't want to be the 0.2 of an analyst. 21 in the S&P, 20 odd for the FTSE 100, and then there's only 4.6. Again, the 0.6 struggles a bit, but covering the world small cap index. And many stocks, actually, something like 20-30% of that index don't even have any coverage at all. And that's really exciting for guys like us who drag down data, dig into balance sheets, do the research, and we don't rely on sell side. All the team does work on stocks, and we find that really exciting. So, 26 times more stocks than Australia, 75% less coverage. 75% less coverage. Where do you think you're going to find most opportunity to invest? So one question we get is, okay, that sounds great, Marcus, 13,000 companies, no coverage. How the hell do you find these stocks? And this is just one example of a filter we use just to show you how we screen down from that incredible universe down to something that makes sense to us. I mentioned earlier that we only buy stocks that have cash flow, so we screen for profitability. Guess what? A big chunk of stocks don't make money in small caps. How many have cash flow that actually converts? Again, screens down to a much smaller universe again. Which ones have a lot of gearing because we like balance sheets that are in good shape. And then finally, which ones have a decent return on capital? If you do that screen, this is again, it's only a schematic. These numbers are actually pretty roughly right, to be honest. I ran that screen the other day and got 500 companies, but it gives you an idea of how it does filter down. And then we go through that and look for stocks that we find interesting or businesses we understand. But it does shrink it down. 400 is still a lot of stocks to cover, by the way. But there's industries we're looking to invest further capital in, or countries we need we're underweight in, we need to add to those, etc. But that does actually shrink it down a lot. So it does give you some sense of what we're trying to achieve. Now, that sounds great again, but how does it all pan down? How does it all flow down into performance over time? And why should I really care about that, Marcus? Well, this is the MSCI World Small Cap Performance since we incepted the fund. The fund's been going for almost 4 years. We started it at the very beginning of March 2019. That's the small cap index over that period of time. If you just screened for stocks in the small cap index that had positive cash flow and decent balance sheets, you got alpha of another 12% versus that index. If you did that, plus applied our bottom-up research, valuation, balance sheets, and cash flow, and obviously some discipline around how we structure the portfolio, you beat it again by another 24%. So it's obviously working. Now, a couple of examples around stocks we own in the portfolio and maybe how we found them, just to bring all that stuff to light. Many of you will be familiar with Burberry, English luxury brand. And what attracted us to Burberry was a couple of things. If any of you have seen us Spherians do a presentation before, we talk about free cash flow conversion a lot in our presentations. That chart on the left-hand side is basically schematic pulling out the EBIT and comparing it to the free cash flow of the business over time. And you can see the dark blue line there is the free cash flow, and the light blue line is the reported EBIT. And it's amazing how often companies that have not good fundamentals don't have a good cash flow conversion ratio. And we like a business that does actually convert well. The average of Burberry is 87% over the last 15 or so years, so it's been a very good cash flow converter. That appealed to us. Secondly, it had been sold off with the market last year. And we picked the stock up with a net cash balance sheet of 900 million pounds, almost £1 billion of cash on the balance sheet. This thing was hugely cash generative. And it was growing and had been sold off very heavily. And we could buy this business on an EV to EBIT of 10 times, which is remarkable. So we bought that in the portfolio. You can see roughly middle of last year. It's re-rated materially since then to about 16 times today. So it's been a really good contributor to the fund, but just shows you that in a world of thousands of small companies, even brands like Burberry, periods where they get sold off very heavily and present really good opportunities if you're prepared, have done the work, and have got these screens that we use. Just to contrast that, what do you think you can buy in Australia on 16 times in the consumer space? Anyone got a name? Woolworths, Coles, something as exciting as that? You can buy the Reject Shop in Australia for 16 times even. So I don't know which stock I'd rather own long term. And just to show you that we're not just about buying glitzy brands based in London, we came across a resource stock as well, using one of these screens, based in America. Very unusual name called SizeCam, because that's a Turkish parent that's taken a stake in this company. But it was called Jina Resources when we bought it. And what it had was a deposit in Wyoming of soda ash. Now, Wyoming, would you believe, has something like 90% of the world's natural occurring soda ash. It's an absolute monopoly of soda ash, a bit like WA with iron ore. Wyoming is the soda ash. Soda ash is used in glass manufacture, detergents and a few other bits and pieces, but it's a really critical component to be used in industrial minerals. And these guys sat on a 50-plus year mine life, and you can see this is the cost curve of soda ash worldwide, and the deposit's so good and so rich that basically they're the lowest quartile producer. 50-year mine life, great cash flow conversion, lowest cost producer in the world, and was trading on 4 times EBIT and paying a 10% dividend yield. Pinch me, that's one of those pinch me moments Buffett talks about. So that we came across that, did the research, got really excited by the company. We bought it, as you can see, again, and it did actually fall a bit after we bought it because the soda ash price fell momentarily, and then has recovered over time and actually has gotten a takeover bid from SizeCam, which is a Turkish parent company that already had a stake in the company, looking to take out the minorities. So it does show you that we do look for both resource stocks and glamorous fashion apparel retailers if they're trading on good multiples. And look, just to wrap up all that, how's it all wrapped up into performance since we've started the fund? The dark line is Spheria's net returns over that period of time. Again, it's almost 4 years now. I think what we're really proud about is not only the fact we've beaten the large cap index and the small cap index, but we've done it with lower volatility and lower risk than the marketplace. So because we buy businesses with good cash flows, good valuations, good balance sheets, the volatility, or how much these shares move around versus the market, is much lower, and we construct things with lower risk. So I guess what I'm trying to show you is that we'd like you to join us on the arc, sail forth and outperform over time, and hopefully hit dry land with good alpha over time. So thanks very much for your time, and look forward to Q&A.